Welcome to a deep dive into a really critical commodity, one that sits right at the center of, well, everything. Global energy security, massive decarbonization efforts. We're talking about uranium.
Right, and it can be such an opaque sector.
Exactly. But today, we've sliced through a whole set of sources, including a pretty detailed strategic risk scoreboard that projects the outlook all the way from 2026 to 2030.
And our mission here is really for you, the investor or the analyst, trying to figure out where the real action is going to be in the next, say, half decade. We're pulling out the key nuggets, the high-impact drivers, and the extreme geopolitical risks.
And what's the big takeaway? The consensus.
The immediate consensus from all the sources is this. The outlook is structurally biased toward high, sustained uranium prices.
Structurally biased. That's a powerful starting point. So we're not just looking at temporary spikes.
No, this is fundamental change.
Okay, so we need to go beyond the daily headlines here and really understand the supply deficits, the policy shifts, and the new financial dynamics that are reshaping this whole market. Let's unpack this structural bullishness, starting with what you called an overwhelming demand wave.
Yeah, let's do it.
When you look at that strategic scoreboard, almost every single driver on the demand side is labeled extreme or high impact and with high probability. At the top of that list is the global reactor build-out acceleration. So walk me through it. Where is this demand actually coming from right now?
It's a truly global thing, but it's definitely weighted heavily toward Asia. China is sort of the predictable anchor here.
Right.
They're keeping up that aggressive pace, 6 to 8 new reactor starts every single year. But the real dynamic shift, the thing to watch, is coming from other players.
Like India.
Exactly like India. India is fast becoming a major global swing factor. They are massively ramping up their domestic reactors, the BHWRs.
The pressurized heavy water reactors.
Right, which are essential for their grid. But they also just advanced a huge financing agreement with France for a big EPR project. That shows they're committed to both their own tech and international tech.
So their demand is just getting clearer and clearer.
It's getting much more visible, yes.
And then you've got the Gulf states, Saudi Arabia, the UAE, they're moving ahead with their first reactors.
Yeah.
That adds a whole new layer of geopolitical tension.
It absolutely does. The UAE is already up and running, but Saudi Arabia is the one everyone's watching. They aren't just hinting anymore. They're talking openly about wanting a vertically integrated fuel cycle.
Meaning they want to do it all themselves. Mining, enrichment, everything.
Everything. That's a massive geopolitical signal. It's not just about energy independence. It's about resource autonomy. And that puts incredible pressure on global supply chains as they try to lock in their own deals.
So while new players are coming in, the old guard is also demanding more fuel through reactor life extensions. The scoreboard rates this as a high-impact driver. Why is just extending an old reactor's life so significant right now?
Because it's immediate. Yeah. It creates demand right now for fuel that wasn't in the original long-term models. You're adding to the burn rate today. We're seeing it in the U.S., the EU, but the critical one is Japan.
What happened in Japan?
Japan just approved life extensions for 3 more reactors this week. 2 of them are scheduled to come back online as early as 2026. This isn't just a theory. This is real physical fuel being drawn down from global inventory.
And you can't talk about demand without talking about policy. The U.S. and EU are all in, driven by energy security and decarbonization. And specifically, the U.S. Department of Energy activated its, a $3.5 billion uranium reserve program.
That's right. And that program is basically a demand funnel. It's explicitly designed to push demand toward U.S. and allied suppliers. But what's maybe even more important, and what the sources flag as a high-impact driver, is the new thing connecting all this policy support.
Which is?
Electrification and the AI-driven power demand surge.
The data centers, the power they draw is just staggering.
Exactly. Policymakers are now openly citing the enormous, relentless power needs of AI and data centers as a key reason for supporting nuclear.
Because you need that baseload, 247 power.
You need it 247, 365. Wind and solar just can't meet that kind of sudden, accelerating demand on their own. It makes nuclear more critical than it's been in decades.
Okay, but that whole demand thesis falls apart if the supply isn't there, and that's where the real volatility comes in. Let's pivot to the supply constraints, because the sources say this is what really cements the bullish argument.
It really is. The demand is strong, for sure, but the thesis is defined by these severe supply constraints and the geopolitical risk packed into just a handful of places.
Let's focus on those geopolitical risks. Some of them are rated extreme potential. What are the biggest pressure points?
Well, the first one is instability in the Sahel region. specifically Niger.
Niger supplies about 5% of the world's uranium.
Over 5%. And the ongoing coups and instability there are a direct threat to mining operations.
Yeah.
This is rated high to extreme impact with high probability because the situation is just so volatile.
And then there's the big one, the anchor of global supply, Kazakhstan.
Precisely. Any disruption in Kazakhstan is rated extreme impact. As the single largest producer, we're talking roughly 40% of global primary output, any hiccup, political or operational, sends prices through the roof instantly. You just can't replace that volume anywhere else quickly.
And all of this is tangled up with Russia, the risk of sanctions escalating.
Yes, Russian enrichment was about 40% of global capacity before 2022, and now a huge portion of that is effectively off limits or just seen as too risky for Western buyers.
Which leads us directly to the bottlenecks in the West. We know companies like Urenco and Orano are trying to expand, but you mentioned this huge time lag. It takes 5 to 8 years to build out new enrichment capacity. Is that delay a real threat or just a known problem?
It's a known problem that's becoming an existential threat for utilities. The lag means we just can't process enough fuel in the West to support all these new reactors coming online. It keeps utilities dependent on potentially hostile sources for way too long.
And that feeds right into the biggest supply problem of all.
The underinvestment in new mines, rated extreme impact, high probability.
So a decade of underinvestment is now crashing into declining performance from existing mines.
Correct. You're seeing the big players, Chemico, Kazatomprom, operations in Namibia, all struggling with ore grade decline and well field depletion. They're literally having to dig more just to get the same amount of yellow cake. It's a structural deficit that's baked in for the next 5 years.
Okay, so let's turn to the market itself. Spot uranium recently hit, over $82 a pound? It's eased back a bit to around 78. Futures are holding strong at about 80. The sources suggest that little price dip was just temporary, something called contractual clearing. For those of us not deep in the weeds, what does that actually mean?
That's a great question. Contractual clearing just means a specific prearranged deal cleared the books, maybe between a producer and a utility. That material then got pushed onto the spot market all at once.
So it was like a one-time blip of supply.
Exactly. It was a one-time volume spike, not a fundamental change in available supply. It soaked up some spot demand, which caused the dip, but it doesn't solve the long-term problem.
That makes sense. And speaking of the market, let's talk about the financialization trend. How are financial players like ETFs and hedge funds changing the game?
They are fundamentally changing it. These physical trusts and funds are systematically removing material from the spot supply and just storing it. It acts like a permanent ratchet on the price floor. Hedge funds now treat uranium like copper or gold.
A strategic commodity.
A strategic commodity. And that means volatility from financial players is now just a permanent feature of the market.
And we saw that this week, right? A new physically backed uranium fund launched in London.
Yep, following right in the footsteps of Sprott and Yellowcake. This isn't just paper trading. This is real metal being locked away. But maybe the most powerful signal of all is the utility behavior pivot.
What do you mean by that?
Utilities have spent years drawing down their stockpiles after Fukushima. They just assumed cheap supply would always be there. Now, many of them are dangerously undercontracted for the back half of this decade.
So they're exposed.
Very exposed. They're facing a real risk of fuel insecurity, combined with this massive new demand from things like AI.
So what are they doing about it? How are they reacting?
With urgency. They are signaling a huge return to long-term contracting. We're talking about plans to add 10 to 15-year offtake deals starting in 2026.
Wow, 10 to 15 years, that's not short-term hedging.
Not at all. It's a massive multi-decade signal that they need security of supply at any reasonable price. We haven't seen this kind of long-term planning since the last big cycle in the mid-2000s, and that confidence is what allows new supply to finally start coming online.
Let's look at that. The mining revival. The U.S. is finally seeing some real action. Anfield Energy broke ground at the Velvet Wood mine in Utah. That feels like a big moment.
It's a huge moment. It's the first major U.S. uranium mining start since the 1980s. It's concrete proof that the DOE's procurement program, that $3.5 billion reserve, is actually working.
And they're targeting production for mid-2026.
That's the plan.
What about in Canada? Cameco is speeding things up at McArthur River.
They are. They're aiming for full nameplate capacity by the third quarter of 2026. And the reason they gave unprecedented demand visibility. That's the key phrase right there.
That visibility comes from the utilities signing those long-term deals.
Exactly. You don't spend that kind of capital unless you're absolutely sure committed buyers are waiting for you.
And then the biggest policy surprise came out of Europe. Sweden overturned its decades-long ban on uranium mining.
A tectonic shift in European politics. That single move unlocked 27% of the EU's known uranium resources. It's a signal that energy security now trumps pretty much everything else.
Okay, so despite all this bullish momentum, we have to look at the risks. What could still cause some turbulence here? What's the biggest high probability risk that could slow things down?
The main one, the big internal risk, is a delay in the SMR and HLU supply chain.
Right. SMRs, the small modular reactors, they're the future, but they need HAU, high assay, low enriched uranium.
That's right. And HLU is extremely difficult to produce at scale right now. If that specific fuel supply chain gets bottlenecked, which is honestly pretty likely, it could seriously slow down the deployment of SMRs. It would delay all that new demand everyone's counting on.
Are there any other bearish risks?
Well, there are some lower probability ones. You can see a temporary oversupply if Kazakhstan suddenly solves all its problems and floods the market,
Yeah.
or something called an enrichment underfeeding rebound. But the sources really view these as later-term risk compared to the geopolitical stuff we're facing right now.
Okay, let's bring it all together. The outlook for the next half-decade. The picture seems pretty clear. Tight supply, accelerating global demand from AI and energy security, financialization, huge policy support. It's all converging.
The period from 2026 to 2030 is just structurally biased toward persistent supply deficits and a lot of volatility. We are, without a doubt, entering a new era of strategic resource competition for nuclear fuel. The price of security of supply will likely matter more than the price of the commodity itself.
So here's a final provocative thought for you to chew on. We noted that major global asset managers updated their ESG frameworks this week to reclassify nuclear energy as green transitional.
Think about what that means. Consider how that massive formal shift in institutional perception moving nuclear out of the bad bin and into the solution column will accelerate the capital flows into this sector. It could make the structural deficit we've been talking about even more acute than our current scoreboard suggests. That policy shift changes who can invest and where that money has to go.